Fed cut rates and ended QT. So why did markets crash? The hidden story behind the MBS unwind. On October 30th, Powell announced a 25 basis point rate cut and confirmed that quantitative tightening, QT, would officially end in December. The rate cut itself was expected, but the early end to QT caught most by surprise. By all standard logic, this should have been a powerful risk-on signal for markets. Yet, in a baffling turn of events, US stocks, treasury bonds, gold, and Bitcoin all sold off in unison. Within minutes, the S&P 500 plunged nearly 100 points, and Bitcoin fell over 2%. Many analysts scrambled for explanations. Some pointed to 2 dissenting votes on the committee. Others suggested the Fed's forward guidance was still too hawkish. But for anyone familiar with the Fed's history, these reasons don't hold up. Dissenting votes are common, and the Fed often uses hawkish rhetoric to manage expectations post-cut. So what was the real reason for the sell-off? The answer, as we've long argued, lies in a single, overlooked keyword, MBS. Buried in the official statement was this crucial sentence. Beginning December 1st, the Fed will reinvest all principal payments from agency debt and mortgage-backed securities, MBS, into Treasury securities. This means that while the Fed is stopping the shrinking of its balance sheet, ending QT, it will no longer automatically roll over its maturing MBS holdings. Instead, it will sell those MBS and use the proceeds to buy short-term US Treasury bills. The total size of the balance sheet remains unchanged, but its internal composition undergoes a critical shift. MBS are being swapped for Treasuries. To put it bluntly, the Fed is now selling MBS and buying Treasuries. You could see this as a minor structural tweak. But this very adjustment is set to trigger a massive liquidity transfer. Quick primer, what is MBS? MBS, mortgage-backed security, a type of bond backed by a pool of home mortgages. Before the 2008 crisis, US banks issued these en masse, and they became a central cause of the financial collapse. The mechanism: thousands of individual home loans are bundled together into a bond, which is then sold to investors. The monthly mortgage payments from homeowners become the interest income for the investors. The 2008 implosion, when US housing prices crashed, mass defaults meant these MBS couldn't make payments. Trust evaporated, prices collapsed, and guarantors were swept into the storm. Lehman Brothers failed overnight, Fannie Mae and Freddie Mac were taken over by the government, and major investment banks faced a liquidity crisis for holding too much MBS. The Fed's rescue? In response, the Fed created its quantitative easing, QE program, and started buying MBS itself to stabilize the market. As of October 2025, the Fed still holds $2.2 trillion in MBS, making it the second largest asset on its balance sheet after US Treasuries. If buying MBS was the emergency rescue mode of 2008, then selling them now is the exact reverse operation. The chain reaction begins. This reverse QE operation will first trigger a major liquidity reallocation. MBS are long-term, riskier assets, with characteristics closer to stocks. They currently yield around 7%. Once the Fed begins selling, the supply of MBS will increase, which could push their yields even higher. This may spawn carry trades, where some institutional investors might be tempted to sell stocks to buy these higher-yielding MBS. Simultaneously, the Fed is using the cash from MBS sales to buy short-term treasuries. This effectively siphons liquidity from the capital markets, which include stocks, and injects it into the government bond market. Therefore, the October 30th announcement on reducing MBS holdings is a direct headwind for US stocks and other risk assets. As we mentioned in our October 28th video, the Treasury General Collateral (GC) rate has remained stubbornly high, indicating that market liquidity is already very tight. The Fed's decision to sell MBS, buy T-bills, is, in a sense, a passive choice to alleviate short-term liquidity pressure in the system. In other words, this is a move to safeguard the Treasury market and overall liquidity, potentially at the expense of the US stock market. The big picture, the great reversal, is here. This brings us back to the conclusion we reached in our July 29th analysis. This series of actions constitutes the precise reverse operation of the 2008 financial crisis rescue. In the current context of severely distorted asset prices, this move increases the likelihood that the market could be forced to revert to its 2008 starting point. And US stocks, having been the prime beneficiary of over a decade of easy money, may be the first in line to feel the pain. This isn't just a short-term sentiment shift. It's a signal of a major trend reversal, driven by the Fed's quiet but decisive structural overhaul of its balance sheet.